And so you can't have it both ways, ladies and gentlemen. You cannot have it both ways. Now, I told everybody stay away from the banks. We are not at a market bottom yet. We cannot have a market bottom until we have a confirmed recession, and with rates remaining elevated for longer, guys, it's pretty clear what's going to happen here. I am not surprised what's going on with regional banks, and I am not surprised what just happened with Schwab. So with the market flat on the day, we're seeing regional banks being a lagger, and specifically, we're going to talk about what's taking place with Schwab. Now, Schwab was over an $85 stock, absolutely sold off when the banking crisis started taking place, and hit a 52-week low of $45, nearly getting slashed in half. Now, with earnings not being as bad as everybody anticipated, the bank bleeding may have stopped. We're seeing with rates being elevated for longer, it's definitely going to be a bigger problem than anticipated. Now, currently Schwab is only down 4 to 5% on the day, but I'm starting to see massive problems here, because if a good quality bank like Schwab is having problems, what do you think regional banks are doing? What do you think the lesser quality banks are doing? And in order to really have a bull market, you have to have a good environment for banks. This is an awful environment for banks, and I tend to think that banks are really uninvestable at this point in time until we see what's really taking place with rates being elevated for longer. And that's why I've been super defensive after this recent rally. What have I been talking about? I've been talking about healthcare, consumer staples, and energy as some areas that I am specifically interested in, because the valuations haven't caught up to the recent rally and their earnings are very defensive. If banks are collapsing, are we still going to need healthcare? The answer is yes. If banks are collapsing, are we still going to need consumer staples? The answer is yes. We still need food, shelter, and water, and we still need to go to our jobs. And so energy, healthcare, and consumer staples is really what I've been pounding the table on, even with all this AI talk, because I still think there's something wrong and we can't have a bull market until banks are ready to lend. In my opinion, we are not at that point in the cycle. What has taken place is pretty simple. The government is stimulating the economy. As we've seen the US deficit skyrocket, we've seen the IRA Act, the CHIPS Act, and Powell had to come in and bail out banks. All this is stimulus and forcing markets to remain elevated for longer, but you can only do this for so long without organic growth. And we'll get to that in 1 second, but I want to highlight Schwab here. Definitely a little alarming, as my brokerage account is with TD Ameritrade, and I'm keeping an eye on this. It's not the layoffs that are the problem, and the fact that Schwab is now lowering its exposure to real estate. The concern is the $2.5 billion that they're going to raise in a high interest rate environment, and they're willing to go roughly 200 basis above where treasuries are trading. So we're talking about over 6-7% interest rate that they're going to have on this debt. And to me, that's a little concerning here. This is definitely bringing up red flags. And if a company well diversified and well managed like a Schwab is having problems, guys, you have to know that there's other banks having problems. And so what's taking place here? It's pretty clear what's happening. Depositors are still fleeing banks to go to money market accounts and treasuries because you're earning over 5% right now on yields, with nearly no risk, and you have insurance on that yield. Not only is this a headwind for the banks long term, but this is a headwind for the overall economy, and the fact that rates are going to remain elevated for longer, which eventually will turn into and spill over into the stock market. We all know that the stock market and the economy are two separate things, but they definitely intertwine when we get financial dysfunctions taking place in the overall economy, much like the financial crisis that took place in 06 through 08. The market does react to that. And I think we're in the early innings of what could be coming in the next 6 to 12 months. And you guys know I've talked about it. I've said that I still believe recession is absolutely on the table for 2024, especially the longer we keep rates elevated. The one thing I underestimated was how well capitalized the consumer was and how much they were willing to rack up debt at any cost. And those were two things I was definitely wrong on. But what am I right on right now? There is absolutely problems in the financial institutes, and we can't have a true strong economy and a true bull market without banks participating and lending. Now, just bear with me. We all know that interest rates were pretty much near zero for 10 plus years. So this massive uptick in the market was contributed to very easy monetary policy and an economy that was absolutely booming. Whether it was stimulus or not, let's just take that off the table, but it was booming. And now we're reaching a topping process, and I've stated this numerous times. And the topping process that's taking place is liquidity coming out of the market, M2 coming down, the consumer slowing down. And so you can't have it both ways, ladies and gentlemen. You cannot have it both ways. You can't have a bull market with easy monetary policy and expect it to continue when monetary policy completely does a U-turn and we have historically high interest rates. We have to give something back. Am I correct? If we have 0% interest rates and we can borrow at nothing when we're borrowing now at 7 and 10%, does this impact the economy? And the answer is yes, guys. What everybody doesn't realize, the problem is what it's going to impact most is what is most interest rate sensitive. And what is that? It's going to be banks and real estate. We've seen a complete collapse in bank multiples and real estate and REITs. Am I correct? And so we're seeing rates absolutely break out. And I said it, and guys, I said it on the channel, on the live stream, the banks are the key to the bottom of this market. If you want to know when it's a good time to buy, it is when the banks are collapsing and the news can't get any worse than it is. I want to reiterate, we've had 4 bank collapses this year, and it's quickly forgotten by the investor that this is taking place. And now we have Schwab raising debt in a high interest rate market, laying off people, lowering its exposure to real estate, and you guys don't think this is a red flag? You cannot have this happen and be in a bull market. If the feds did not step in to bail out the banks, it would be much uglier than it already is. And so we've had 10 years of an upward direction with easy monetary policy, and it's really only been about 12 to 18 months of harder monetary policy. 10 years versus 18 months. It's going to take time for this to get through the economy and truly feel it. And that has been my thesis on this channel, and that is why I've remained very defensive. And maybe you guys think I'm a perma bear. That is not the case. I think there's way more opportunities in companies with single-digit PEs that have defensive earnings that may pay a dividend or return capital, and those companies are getting overlooked while banks are still in the process of collapsing. We're talking over a decade of easy monetary policy versus a very few short months or maybe even a year of us feeling the true impacts. It's going to take time, ladies and gentlemen. The one aspect that nobody's talking about is duration. And I mean, nobody knows what is going to happen over the next 8 to 10 months because we don't know how much more rates are going to impact the banks, much like we're seeing with a company like Schwab, or what's going to take place with regional banks now. Because I tend to think if Schwab is having these massive problems, you bet your butt that regional banks are very concerned with the breakout of the 10-year going above 4.25. Their assets are underwater, and if people start bailing on the banks to put their money in money markets, and if people start bailing on the banks to put their money in treasuries and money market accounts, we're going to see more chips fall here. And trust me when I tell you, the feds can't make everybody whole. Now I tend to think that there's a probability that the feds can't even raise rates at this point in time. And that could be short-term bullish for the market, depending on the rhetoric. The only thing I think that has really propped this market up is AI and the fact that stimulus has still been pumped into the economy, but we're starting to see that stop. The feds are unloading a balance sheet. The United States is issuing more debt and nobody's buying it, and yields are spiking because the supply demand is now shifting. Guys, I told you China and Japan were going to be wild cards, and I think that is still the case here. If we keep issuing more debt and nobody's buying it, we're going to see rates tick up even higher, as crazy as that sounds. Once again, guys, this is just my opinion. I go through the data with you on a daily basis. We talk about earnings, but I truly believe that there is definitely more problems taking place as small business sentiment is now ticking down. We have concerns now with companies like Schwab. That is definitely sending some red flags to me. And obviously that should start impacting what's taking place with regional banks as well. And for a country where 70% of our GDP is based on consumption, Yes, consumption has remained strong. I'm not going to deny that. But if banks are still having major issues and not lending, this is obviously going to send concerns to the consumer, who's going to tighten up their spending habits, also limiting the banks to lend out money for growth as well. These two headwinds are the headwinds you need to watch going forward, because I tend to think GDP is going to turn negative pretty quick come 2024. As always, appreciate your time. Thank you so much for spending it with me, and we will see you in the next one. Peace.